10 months ago, this company rang the opening bell on Nasdaq and was worth $3.5 billion. The two men who built it weren't nobodies. They were, by any measure, crypto royalty. Olympic rowers. The identical twins who famously took Mark Zuckerberg to court, claiming he stole the idea for Facebook. And, using the money from that fight, two of the very first Bitcoin billionaires on the planet. When their crypto exchange went public in September of 2025, it felt like a coronation. Today, that same company has lost almost 90% of its value. Its stock has gone from a high of around $45 a share down to about $4. And the most uncomfortable part isn't that it collapsed. It's that it collapsed slowly, in broad daylight, while the people in charge kept insisting everything was fine. This is the story of Gemini and Cameron and Tyler Winklevoss, and how a coronation turned into one of the most brutal unwindings in recent crypto history. Let me take you back to the beginning, because the setup matters. The Winklevoss twins are, whatever you think of them, genuinely remarkable. They rowed for the United States at the 2008 Beijing Olympics. They walked away from the Facebook lawsuit with a settlement of cash and stock, and instead of just retiring on it, they made a bet almost nobody was making back then. They poured that money into Bitcoin around 2012 when it was trading for a handful of dollars. That bet made them billionaires. And in 2014, they founded Gemini, a crypto exchange built on a very deliberate pitch. We are the regulated, trustworthy, grown-up option. While other exchanges played fast and loose, Gemini wanted to be the one your accountant wouldn't be scared of. For a while, that reputation held. And so, on the 11th of September 2025, Gemini went public on the Nasdaq under the ticker GEMI. And here's a detail worth getting right, because it tells you everything about the mood. The shares were originally going to be priced around $17 to $19. Demand was so hot, they raised it, and raised it again, and finally priced the initial offering at $28 a share. When it actually started trading the next day, it opened at 37 and touched 45. The company was suddenly valued at over $3 billion. Champagne all round. That was the peak. It has been almost all downhill since. So, what went wrong? This is where it gets interesting because there isn't one dramatic villain. There's just a slow accumulation of cracks. The first crack was the market itself. Gemini makes most of its real money the old-fashioned way for an exchange. It takes a small cut every time someone trades. But right as they went public, the crypto market rolled over. Bitcoin slid from around $115,000 near the IPO down towards $60,000. And when prices fall like that, people stop trading. Trading volume dries up, and the fees dry up with it. In their first quarter as a public company, the core trading revenue, the beating heart of the business, fell by more than a quarter. Now, in fairness, and I want to be honest about this, their total revenue actually went up because they hustled to make money from other things, credit cards, staking, custody. So it's too simple to say revenue is collapsing. The more accurate and honestly more worrying picture is this. The main engine of the business is stalling, and they're frantically bolting on new engines to compensate. And then came the second crack, which was self-inflicted. In February of 2026, barely 5 months after the IPO, Gemini announced a dramatic pivot it called Gemini 2.0. They would pull back from entire regions, the UK, the European Union, Australia. They would lean hard into new areas like prediction markets, and they would cut somewhere between a quarter and a third of their entire workforce. Now think about the message that sends. You just told public investors months ago that you were a stable, growing global exchange. And now you're retreating from major markets and laying off a third of your staff. That is not the behavior of a company that has things under control. That is a company scrambling. The third crack was the one that really shook confidence. Just 12 days after that pivot, 3 of the most senior people in the company walked out the door at the same time. The chief operating officer, the chief financial officer, and the chief legal officer. all at once, less than 6 months after ringing the bell. When your COO, your CFO, and your top lawyer all leave in the same breath, investors don't need a press release to translate it. Something is wrong on the inside. And underneath all of that sits a brutal, inescapable fact. Gemini is small. In a market dominated by giants like Coinbase and Kraken, Gemini's slice is under 1%. When the tide is coming in, a small player can still make money, but when the tide goes out, the small players are the first to get exposed because they don't have the scale to absorb the pain. You could see the strain in the moves they started making. In July, they launched commission-free stock trading, free stocks, trying to muscle into territory owned by Coinbase, by Robinhood, by Cash App. And the market's reaction was telling. The stock didn't rally on the news. It fell. Because to investors, a struggling crypto exchange suddenly giving away free stock trading doesn't look like ambition. It looks like a company desperately searching for something, anything that works. Put it all together and the numbers are grim. For the full year, 2025, Gemini lost around $585 million, more than 3 times its loss the year before. Analysts began abandoning ship. Citigroup slashed its price target to $4 and stamped a sell rating on it. And a group of shareholders did what shareholders do when a stock craters right after an IPO. They sued, alleging the company misled them in its offering materials and hid the fact that this dramatic pivot was coming. One analyst at Citi put the whole thing beautifully and almost gently. He said management's credibility had been challenged by the gap between what they laid out before the IPO and what happened after. That is Wall Street's polite way of saying, we no longer fully believe what you tell us. Now here's where I have to be fair, because it's not all doom, and this is where I'll give you my actual opinion. The Winklevoss twins are not going quietly, and they clearly still believe. Around the middle of this year, they personally committed $100 million of their own money back into the company, buying shares at $14. Some headlines called it a bailout. I'd call it a signal. The founders putting their own fortune on the line to say, we are not done. And there was one piece of genuinely good news that often gets lost. Remember the old Gemini Earn scandal, where a partner called Genesis froze around $1 billion of customers' money back in 2022? After years of legal warfare, this January, the SEC actually dropped its case against Gemini because the Earn customers had been made essentially whole. That's a real, meaningful win, and it deserves to be said clearly. So, is Gemini finished? Honestly, I don't think that's the right question. Here's what I think this story is really about. When you go public, you are making a promise. You are standing in front of the world and saying, here is what this business is, and here is where it's going. The market gave Gemini an enormous benefit of the doubt, a $3 billion valuation, based on that promise and on the twins' golden reputation. And what the collapse of this stock represents isn't really a bet against crypto. It's the market slowly, painfully repricing that promise as it discovered the reality underneath it was messier, thinner, and more uncertain than the pitch suggested. That's the brutal thing about public markets. Reputation can get you in the door and get you a spectacular opening price. But it cannot, month after month, paper over shrinking trading revenue, panicked pivots, and executives heading for the exits. Eventually, the story has to match the spreadsheet. And when it doesn't, the gap gets closed the hard way. One bad quarter at a time, 90% of the way down. The twins built something real, and they may yet turn it around. $100 million of your own conviction is not nothing. But the lesson here is bigger than one company. Be very careful when a hot new listing is being sold to you on the strength of who's behind it, rather than what the business actually does. Because a famous founder can ring a very loud bell. What they can't do is force the numbers to be kind. If this breakdown was useful, do me a favor and subscribe. I take the biggest stories in money and make them make sense. No hype, no jargon. I'll see you in the next one.